Everybody can hear me all right?
Yeah.
Now that we're sitting next
Wonderful.
Yeah, right.
So in light of some of the comments about knowledge fatigue, I think we're all drained, and we're going to keep this as brief and concise as possible. I'm going to lead off with a theme that hopefully you all can relate to, and it's about the kids. So the children are our future, the kids are our future, and that's the domain that I live in as Director of Student Entrepreneurship at the University of Toledo. And so a lot of what we're going to talk about is how to mature entrepreneurs into business owners and business leaders. And the problem, I think, with a lot of the discussion in crowdfunding is all about the funding part of the crowd. And so we're going to touch a little bit on some other subjects that relate to how to build a sustainable business, how to engage your stakeholders, not just necessarily your shareholders. And that's basically where it is. So the theme, obviously, is entrepreneurship, startups, and financing, or I could also call it how the crowd is facilitating and accelerating entrepreneurial initiative, because really it's about initiative. It's about taking that first step, showing up, and getting involved. So very quickly, I'm a lifelong entrepreneur, and I can assure you that entrepreneurship is an ever-evolving process, as many of you probably know, and it requires us to adapt to constant change. That's human nature. I think it's one of the reasons why crowdfunding is so inherently attractive to so many people. But I immediately saw the powerful dynamics about crowdfunding the same way that I saw how internet was going to change the world. And it was just one of those light bulb moments where I'm like, wow, this is everything. And so when I was fortunate enough to get a call from Dara Albright here many years ago saying, we'd like you to join this CFPA and maybe you could get involved. I'm like, I'd like to look into that, and I will. And so since that time, I've been involved and will continue to be involved. And I hope that all of you here today who've shown the initiative to show up will do the same and get involved with us as we really start to build out the organization in the spring, now that we finally have full rules in crowdfunding. To skip forward actually 20 years and a few dozen startups in the process, I really think that crowdfunding is the best expression of the internet. I think it's the best and highest use of the internet right now, and I hope that you share that passion as we go forward. So as far as designing an entrepreneurial ecosystem, which is what I'm doing at the University of Toledo, there's three main themes, and I think they're going to be kind of subtext to this discussion, which are strategy, communication, and execution. Now the strategy part is kind of, piecemeal with the nature of a crowdfunding campaign. People that have an idea have to learn how to express that idea, they have to learn how to communicate that idea, and then ultimately they have to deliver on the promise of that idea once they take someone's money. So we're going to get into it here. I'm going to feel very grateful to introduce our panel today. I'll let them tell you a little bit about their work, but sitting at the end is Blaine McLaughlin. He's head of VIA Folio, that's Folio's private capital network. And supporting unlisted securities. So it's a different space for a lot of us, and I think the discussion previous with secondary market is also germane to where we're going to lead a few of these calls. We have Gene Massey here on the end. Gene is a media pro and current CEO of Media Shares, helping connect issuers and investors. And Kevin Provost in the middle is a longtime colleague of mine based in Philadelphia and is CEO of CoFund 360. This is an innovative business accelerator, networking mentors to startups in a highly structured program, very similar to what we do, kind of fusing curriculum and accountability into a very time-limited process. So it's a fast-moving accelerator that he'll be happy to tell you up. So if you guys have anything to add to that, Blaine, you want to start and just give a quick, if you haven't already today?
About who I am and why we're here?
Yeah.
I don't want to repeat too much. We do have most of the same folks in the room. Via Folio is, as you said, Folio's private capital network, and Folio is a clearing broker-dealer that provides services not only to our own many tens of thousands of investors, most of whom are registered investment advisors and their clients, but also to other broker-dealers and platforms to enable them to buy these private securities in an online brokerage account. And I think we're going to hit on some really interesting topics related to that in this panel, so I won't belabor the point.
Right.
Yeah. So as Scott mentioned, we run a network of what we call alternative accelerators, and I almost hate to use the word accelerator because it has a stigma that one of our previous panelists, I think, brought up, with a very low success rate compared to the Y Combinators and Techstars of the world. So I'd like to try to differentiate between what Y Combinator and Techstars does and what we do. We're much more of a curriculum-based, hands-on, early-stage mentoring group that provides a whole bunch of business services in addition to some capital and some expertise. So we focus primarily on markets and industries that are underserved by venture capital. We're based out of Philadelphia, Pennsylvania, so it's not really known as the VC hub of the United States, right? So interested to talk to this group and share a little bit about how we see that scaling in in the States here. And on the other side of the coin, I work a lot with institutions of higher education to help bring crowdfunding ecosystems into the institution. So both on the student entrepreneurship end, through the alumni development, tech commercialization, I'm happy to talk a little bit about that today as well.
Gene.
I'm Gene Massey with Media Shares. In 1999, we filed a patent for crowdfunding, and it was allowed in 2004, a business method patent like Priceline, Netflix, eBay, and unfortunately, it was only for movies. So we called it fan financing at the time, and it was based on the principle of pre-selling DVDs to finance the movie, selling a share of stock and giving a DVD as a dividend. And eventually it became crowdfunding, and I think in 2006 is when the term came out. And so we didn't have the foresight to realize that it was a methodology for financing anything. And we are at presently building out a platform for financing movies, a studio model using Reggae Plus. And so we're going to be working with Folio, and one of the things that one of the reasons I wanted to talk about that today is have Blaine here about it so we can explain a little bit about what we're going to do.
Great, thank you guys. So very quickly, there's a lot of new tools in the space that I work. The subject of lean development is common and growing. And so there's a lot of tools of the trade, such as business model canvases. We have rapid prototyping that is now de rigueur in college campuses, as well as a constant feedback loop with your stakeholders. These aren't just investors, these are supporters, these are people that can be customers, marketers. That's really important. In crowdsourcing, intelligence is a key component of the crowdfunding talk, and I think a lot of people leave out the crowdsourcing part, which is really where crowdfunding is based in. It's a subset of crowdfunding is. So anyway, these tools move entrepreneurs from ideas to validation faster than they ever have before. So my question to the panel is going to be, what advice do you have for preparing entrepreneurs to actually run the startup that results after a successful campaign? So I think, Kevin, you probably start that one out, and the rest fill it in.
Yeah, I mean, so the question is, how do you coach a company or how do you coach a founder to run a startup? So I'm going under the assumption they've never run a business before. And a couple things we look for when we're vetting potential companies that we want to work with who are looking at crowdfunding as a primary means of financing their own business. It's be comfortable knowing what you don't know, let alone running a business. In the crowdfunding world, there's a lot you probably don't know, so be comfortable with that. And then the second part of that is surround yourself with experts who know a heck of a lot more than you do, and lean on them as much as possible. So there's, I think, oftentimes even a generational difference that we see in business owners who've run businesses in the past who are not comfortable sharing information and getting crowdsourced feedback and asking for help outside of a really closed circle versus first-time entrepreneurs who oftentimes do too much of that, too much disclosure without really protecting their IP and things of that nature. So be comfortable knowing what you don't know. Surround yourself with people who are smarter than you. We look for resiliency, coachability, simple human characteristics that most mentors and advisors probably like to see in their own clients. So it's not rocket science from that end, but how to run a company, learning by failure and viewing failure as a learning opportunity, not as a negative.
I think two key things that Kevin mentioned that I can expand on is, one is having a network of mentors available to you, and this happens to be the bottleneck that we're experiencing. I think most startups experience a lack of qualified mentors to help them. An investor is not necessarily a mentor, and I think we're going to touch on this in a few minutes about how to deal with a mass of high expectation investors in your business. We'll talk about that in a second, but the mentor component is a big one, so actively participating with a large group of mentors, especially ones that take interest in your business because they share an affinity with it, is absolutely critical. So networking with organizations that have a large group of mentors is invaluable, and I really would strongly recommend any entrepreneur do that. The second part is, again, kind of in that lean startup theme, is that one of the advantages being associated with an incubator, an accelerator, is the opportunity to fail before it's critical. And this is absolutely critical, especially in my case when I'm dealing with very young people. I start with 17-year-olds, freshmen, engineers. For the last 2 years I've been counseling through this process as a mentor, taking them step by step through exactly how it is that you do and what you do. And one of the first things I tell them is, there's not a VC in the room that's being honest with you if he tells you that failure is a bad thing. Failure is what they expect. In fact, their business model is based on failure. The faster they fail, the less money that they lose on you. So failing quickly is actually kind of it's a new underlying theme in venture development at our stage. So being associated with an accelerator like Kevin's or any is actually an opportunity to fail quickly without much consequence. And so that ability to get back up, it's, that's what entrepreneurs are. They're risk takers with a plan. You don't get disappointed, as Sasha told me earlier, a wonderful quote. An entrepreneur is one who can fail and fail again and yet still retain his enthusiasm. So that's a huge part of the reality of the entrepreneurship that we're trying to instill in people. So.
Yeah, we always, for first-time entrepreneurs, we also talk a lot about things like Franklin Covey and leadership development, and a lot of those practices are focusing 80% on the founders or the business's strengths and their circle of influence, and 20% on their circle of concern or things that are outside of their control of influence, which is what we encourage mentors and advisors, and building your first team members around your liabilities such that you can really capitalize on the assets that the business has. So most first-time founders are very concerned about what is out of their control, what they don't know, and they're not really sure how to pursue it. Short answer, surrounding with mentors and getting them to do that work is the easiest path forward.
Yeah, I double down on that a little bit. As a potentially a later stage interacting firm with an issuer that wants to raise money, we want people who are already going to have had some of that support, but even more so, we want some of that support. As a broker-dealer or as a clearing firm, there's a lot of stuff we can do and we can do well, but we can't do everything. And I don't, for example, see us as being the experts in biotechnology cell development methods. We want to work with people who are experts in that field so that we too are surrounding ourselves with this network of experts that not only are beneficial to us but beneficial to the firms. And that's partly a request out, is that none of us can do this by ourselves. And whether we talk about working together in syndication or we talk about working together on creating the supportive network for the entrepreneurs to help them work their way up the ladder, really important. A different point that you made earlier is once they're running the company, from a securities perspective, we want them to continue to communicate with their investors, and partly that's on them to come up with things to say and meaningful updates and making sure that they're doing so in a sort of compliant way. But partly it's on us as technology providers and securities professionals to give them the channels to do that. I think my colleague Tom Lawson earlier mentioned, having, for example, the chat room functionality on the brokerage site that allows the investor to ask questions, not just during the subscription process, but over time. And in the same way, it allows the issuer themselves, that entrepreneur, to communicate with the community.
Great. On the subject of compliance, there's another subject that I think Gene's probably going to want to tackle. So much like in the early days of the internet, getting above the noise that will surely rise in this new marketplace is going to be a huge challenge. So I have a series of questions that will go. I'll just read them out and you guys can tackle them as you go. How can entrepreneurs market their offerings, especially equity offerings? How does one reach accredited investors if one does not know any accredited investors? How do you solicit non-accredited investors online? And how does an entrepreneur comply with regulations when marketing his or her offering? So. I know it sounds like a lot.
We have another day.
I'll take that last one because it's easy.
Pick one you like and just run with it.
I'll take the very last one because it's easy. Use good securities counsel. There's lots of them here. I think they've been doing a really good job of making themselves visible, available, pricing their services for getting started companies in really aggressive ways that don't look anything like the law firms of the past. They're starting, like I disclosed, to put tools online to make it easier. So I think there's that piece. Obviously, that's not the first step in their process. The first step in their process is to work with a guy like Kevin or yourself to get educated as to what they need to do. But those tools are there. That was easy when I'm done.
Right on. Gene?
Here's the real issue for an entrepreneur. I want to go out and raise some money. Okay, can I post something on my website and raise some money? No, you can't really do that very easily. You have to have money to get money. You have to have money to comply with all the regulations. When Patrick McHenry wrote what was it, 3940? The original Title III was written by Patrick McHenry. Very simple. You post something on your website, and you can only take a certain amount of money from non-accredited people. And to protect people from losing their life savings in your terrific idea. And it became something that was very onerous. You had to have a certified audit. I mean, by the time all the regulators got through with it, it was impossible for an entrepreneur to use as written. So even today, with Title III, I think Sarah Hanks said to do a Reg A Plus is $40,000 legal fees, and you've got to have a certified audit. So by the time you're finished marketing it and everything, you're probably looking at a minimum, absolute minimum, $150,000 to try to raise money from non-accredited investors under Title IV. And I don't know how cheap Title III can be, but it's going to cost you some money. There's no way to get any money without having some money already. That's the issue. And so, and maybe that's a good thing, because you have to convince somebody to give you some money before you can get some money. And one thing that everybody seems to forget is, when you're asking an investor to give you some money, you're asking them to give you their money. Their money. You mean I have to give you some of my money? It's a very, very difficult thing to get some money from someone. And so you have to put something on the internet that's exciting enough for them to give you their money. And it's not just an advertisement. It's not just a little posting that they're going to respond to and send you some money. It requires quite a bit of thought and an expense. So it's really expensive for an entrepreneur to get any money.
That actually segues into two more points very quickly that I can mention in setting up the discussion of funding. Again, we're here to talk about funding, but again, the purpose of the entrepreneur's path is a continuum. It's not just the funding component, which is not first, and it's certainly not the last. And I wrote a simple statement, which is entrepreneurship almost always begins like trial by fire, but more than often ends in flames. So how can the crowd help entrepreneurs avoid burning out too early? And so this kind of touches on it, but just as you're saying, you need money to find money, and that's absolutely true. How can the crowd actually offset a lot of the workload and expense that you would otherwise have to endure in a standalone process? Because again, your investors are your best salesmen as well, and theoretically, the dynamics we now have in crowdfunding facilitate the type of communication and free marketing that you simply didn't have before. I guess I answered it. Anyway.
Well,
right.
How do you prevent burnout? Is it?
Yeah, basically, yeah.
Yeah, I mean, I think the crowd is there. Probably my biggest issue with the industry is that we only use the crowd for funding, and it's useful for a heck of a lot more. There are websites that then do just ideation, and there are websites that do microtasking, and there are websites that do open innovation, and all of these are forms of crowdsourcing that should be applied within the crowdfunding process, or around, or before, and sometimes after the crowdfunding process. So, the crowd's good for, qualitative feedback on the product, for emotional support as you're, doing a test the waters campaign, for referrals, for endorsements, for affiliate marketing. I mean, the crowd can provide a ton of insight into whether or not you should even be in business if you engage them early enough.
Do that before you ask for money.
And kind of like the question you asked before, which we get all the time when early issuers are coming to us saying, hey, I got a business idea, I've been doing it for 6 months, I'm trying to figure out if I should take the next steps. How do I market myself before I'm ready to talk to investors? And then how do I find these investors? It's aligning your public narrative in the form of your LinkedIn, your Facebook, your company's website, your blog, making sure that's all consistent, and then knocking doors. It's not rocket science how you go out there and meet people who are going to be interested in what you're doing. It's knocking doors and getting introductions. So
yeah, it's not build it and they will come. We've learned that painfully. And university students, I like to say, are natural born networkers. I like to say they have such strong thumbs. They're on this thing all day long. They go in class and out of class. And I think maybe that's why crowdfunding is such an enthusiastic response from young people. it's an interesting time, and I think that if we just harness their inherent capabilities of having hundreds and hundreds of friends and simply telling them, well, that's social capital. It's all you have to ask now is how do you turn that into real capital? And that's really the process that we're talking about with entrepreneurship. But it is a continuum. So we've talked a lot about entrepreneurs and investors, but let's talk a minute about the industry itself. And Kevin kind of posed this question. I think Gene may also have some input on it. But what do entrepreneurs lack or need that the crowdfunding industry leaders, such as all of us in this room, could assist with at this stage of the industry, which could reduce adoption barriers, right? How do we make sure that everybody's aware of crowdfunding in a way that it's natural to them and it seems natural to them? Kevin.
Yeah. So a lot of the panelists mentioned a lot of this stuff before. I know Richard mentioned kind of a crowdfunding Bill of Rights. It's got to be there. There's got to be uniformity amongst the people in this room before students at the university level are going to be able to understand the difference between rewards-based, donation-based, peer lending-based, and equity-based within the first 30 seconds, right? So it starts in this room, and I think a couple things like partnerships with universities, the research that's not being transferred outside of the university ecosystem is a big issue. Richard again mentioned, I think 13 or 12 universities who have serious research initiatives going on in this industry, but it's not really making it to the small business development centers, the SBAs, the accelerators, the incubators, the groups that are doing public-private funding within cities. So the creation of industry best practices is one issue that this group has to tackle, but then the dissemination is a whole other thing. And so that starts with hopefully some agreement on what best practices look like. And it requires a lot more education and training.
Kevin brought up a really key point that I'd love to impress on you, and that is that universities are an incredible wealth of resources. The problem with universities is that they kind of act like walled gardens. They like to keep everything to themselves. They kind of hoard their resources. They don't share amongst themselves, which I found completely shocking and anathema to the point. But there is room. And even if you're not an alumni, there's room. Because they are, for public universities in any event, they are accountable to the taxpayer, and that's you and you and you and you and everybody. But the resources that they have, the access that they have, and frankly, a little bit of the clout that comes along with associating yourself with them, in any event, is very valuable. So I would strongly recommend, if you're just interested in this space, if you don't have an absolute defined territory that you're going for, simply make a visit to your business school or to your engineering club or to your alumni development office and ask, because that can actually spark some movement that maybe they've been thinking about anyway. So I would strongly advise you to do so. Any other thoughts on that?
I would also just quickly mention whether it's part of the crowdfunding Bill of Rights that is maybe in the future here, or a separate mantra that maybe the CFPA and CIFRA kind of pushes. There's got to be an open data pledge that, again, industry leaders first take, that then every issuer and or accredited or unaccredited investor takes when they opt into viewing deals and participating in mentorship and advisory of crowdfunded entities. Open data is like the key for this industry, and that means crowdfunding portals sharing some data sets with the CFPA and groups who they know are kind of platform agnostic. And it's difficult because nobody wants to share their secret sauce at this early stage of the game oftentimes, but
we're starting to see some platforms have APIs with limited access to data. I think that's probably going to be something that they should be intimidated and pressured into doing, in my opinion. It's a matter of social responsibility at the end of the day, and crowdfunding is about the social contract. So crowdfunding comes in all shapes and sizes, as do shareholders. And with potentially thousands of them weighing in on every facet of your new business, what advice do you have on managing new backer investor expectations, and how do you convert them into stakeholders?
Gene, you take that one. I'll take the next one.
Well, if Disney's got 1 million shareholders, so crowdfunding is not really anything new. It goes back to 1606 for that matter. Let's get a lot of people to invest in something. What's happened is you're able to fractionalize the investments. What the internet has done is it enables you to fractionalize it into tiny investments, even maybe as Blaine and I are working a way to try to sell single shares to fans, a NASCAR team or a movie that we could sell single shares to. So what a young entrepreneur could do to manage expectations is be very, very open and very transparent, and basically spill the beans to your crowd and be willing to accept from the crowd their feedback. And as we know, all of the platforms are going to have forums on them. And if an entrepreneur can really listen to what people are saying and respond to those people just like they would respond to a mentor or an advisor or an attorney, then they would have a greater degree of success, I think, and they have a wonderful resource. You know, for many years I was a film director, and we had a crew, a big union crew, and I set the stage for everybody to give me feedback, and the guys would have excellent ideas. The grip would have an idea, the gaffer would have an idea, the sound man would have an idea. Why don't we put it here? Oh yeah, I hadn't thought of that. So if you can convince an entrepreneur to be willing to be open to feedback from the crowd and accept it, I think that's their greatest possibility of success.
Without being drowned by it. This one's going to go to you, Blaine. So retail investors are used to traditional forms of investment. So until we have a robust secondary market, how do you address the lack of liquidity?
I'd say that's a tough one, and it's been covered to a degree in some of the earlier panels of different ways to do that. I touched on it a little bit. Of part of a vibrant secondary ability is actually having current information on the company, and that's the company's responsibility to get that out there. And whether it's an internal exchange that's run by a clearing platform like ours, or if the company's ready for latter stage with actual secondary listings on, for example, the OTCs, whether it be QB or QX, I think there's potential for that. That may not be the most fulsome answer, but it also gets to some more interesting questions about how much liquidity is really needed in that space. Do you want to encourage investors to look at a heat map and do private investment sales on a millisecond notice? Probably not. It's probably not good for the company or the investor. You probably want some longer holding times. And if we can process the more basic death, divorce, I need the money now sales, that might be all that the company or the investor really wants. So when you talk about a vibrant secondary market, I think you almost need to define what you really want out of it. So that's my 2 cents on that one. I did want to come back to a different topic. You threw out like 19 questions in a row, and one of them was, where do you find investors? And I think we've touched on a couple pieces here, but I want to tie them back together a little bit, which is the stats from Kickstarter, Indiegogo, Rocket Hub are that roughly 90% of the investment dollars come from people
Yeah.
So it is getting out and getting that feedback on a human basis. I heard some rough numbers today on how it sounds like Elio is doing, and it sounds like roughly 60% of the dollars for that are coming from this rabid fan base. I love the fan approach. It's even better than crowd. Man, I hope it sticks. So there's a lot of how do we leverage the crowd? How do we leverage people we don't know? How do we leverage the internet to reach people we don't know? And there's a certain value in that, no doubt. But there's also a certain value in using those same mechanisms to facilitate activity with people you do know. And then there's the somewhat sort of going back to the Stone Age a little bit of you still have to talk to people. Yeah. And it sounds funny for me as an online brokerage person to say that, but it's so meaningful I felt like I needed to hit the point home again.
Go ahead.
Talking about fan financing, you mean you want me to sell my share of stock in Dale Earnhardt? Well, I bought a share of stock in Dale Earnhardt, and I'm going to keep it. I'm not going to sell it. That's what you're dealing with fan financing. If you have a movie or something, the reason they bought a share of stock in that particular thing was because they love it. I'm not going to sell my stock. Now, you do need to make it available for them to sell it if they decide they want to. You can sell it right here. And Blaine and I are talking about, Folio and I are talking about a way for an issuer to have on their website a place that they can sell the stock. It's legal to have a bulletin board on the stock and match buyers and sellers. And if it's done with a brokerage, we're discussing ways that might be possible. So you could say to a Dale Earnhardt fan, you can sell your share of stock here. if you absolutely decide you want to do that. But the whole purpose of fan financing is I'm buying into something because I'm a fan, I love it. So liquidity may or may not be the most important thing, particularly in fan financing.
Yeah. So we're about to end. I'm going to end with one final remark on this, and it's about the continuum again. This discussion was on entrepreneurship. It was on and on financing, and on the financing component, I actually think it's really important to impress on anybody that's thinking about going out and launching their initiative to do a crowdfunding campaign without having had any experience at pitching, taking feedback, iterations, and such. I think is a huge, huge mistake. There are countless numbers now of pitch competitions. Ever since Shark Tank came on TV, you'll find them in every city, especially at universities. So my best advice would be busy yourself with showing up at these things from the lowest possible stage. Go out, pitch for $50, pitch for $100, and keep going up that time, because every time you do it, you're going to learn something, your pitch is going to get better, and by the time you actually do meet the investor that you want to find, even if it's a whole crowd of investors, your story's going to be tight. Richard?
I got to back you up. There's actually research out of the Netherlands that companies that are successful in crowdfunding typically have participated in business plan competition and an accelerator. Sorry, there's actually data from research that shows that companies that have gone through a business plan competition and have pitched at least 3 times are statistically more likely to be successful in crowdfunding.
I think I just saw that report last week. It was like 86% success ratio, which here is
phenomenal.
Unfathomably
And
good,
real quick,
so.
can you talk about the follow-on financing numbers for companies in Europe who've been successful raising equity crowdfunding? What's their success rate in finding follow-on financing? Do you know those?
Not real quick, but I can tell you that many of them have received subsequent funding, and the most interesting thing is the viability. They're over 90% are still in business.
Yeah, okay. That's what I was looking for.
Great. All set? Thank you.
Thank you, Scott.
Thank you.